Good morning, good afternoon, everyone. My name is James Bogart, President and CEO of Bogart Wealth. Just a real quick introduction on who Bogart Wealth is. So Bogart Wealth, our core competencies are financial planning, investment management, tax optimization, and tax preparation. We're what's called a registered investment advisory firm, so we're fully independent. We're managing approximately $1.1 billion of client assets. It's about 750 households. 90% of them are ExxonMobil households, so high level of proficiency within the ExxonMobil benefit programs. We are true fiduciaries for our clients, means that we're legally obligated to put your interest above our own. No hidden agendas, no conflicts of interest, very transparent in terms of our fee schedule and how we're compensated. We've got 19 folks now on my wealth management and planning team. I've got 4 on my tax team. I've got 3 office locations, one in McLean, Virginia, one in Houston, Texas, one in the Woodlands, Texas. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. I always emphasize that intergenerational piece. We found that our clients' kids and our parents can be some of the largest variables of anyone's financial plan. We've made it part of our firm's culture to give them access to certified financial planners early on. Hopefully, we know the impact that we can have by starting to do some work at an earlier age. One of the calls to action from this event is to actually sit down and run your numbers. If you haven't taken us up on the opportunity to do so, it's absolutely no cost, absolutely no obligation. Great way to see where your situation's at now, but also ways that we can find value or enhance what you're doing now. So today's talk is actually one of several events that we do. We call it our Retirement Readiness Series. We have an event that we do on the retirement planning timeline, one on retirement income planning, one on Social Security and Social Security strategies, one on tax planning and tax optimization strategies, one on estate planning strategies, one on net unrealized appreciation and post-retirement income strategies, long-term care and long-term care insurance, Roths versus traditional IRAs and 401ks, and then one on the mega backdoor Roth conversion strategy. This list has come from our audience. If there's a topic that you'd like to hear us talk about, we're delighted to do so. Just send me a note. And we do record all of the events. So every one of these now is actually up on my website. You can feel free to go and log back in. Some of these we're updating more frequently, for example, this one today. And so today we're going to be talking about how the discount rates affect the ExxonMobil lump sum calculations. Real quick, a couple administrative items. I do have the question and answer box open as well as the chat box open. Feel free to ask questions along the way. And again, we are recording this, so if you'd like a copy of the recording afterwards, please let me know. We're more than delighted to send that out. Oh, and then at the end, we also have a survey that we ask for some feedback. Always love to get feedback and see how we can improve these going forward. All right. So with regards to the discount rates and how they're calculated, this is all based upon a change that occurred in 2006 related to the Pension Protection Act of 2006. And so what the Pension Protection Act did was it limited companies offering lump sum options and the funding requirements for them. It defined the discount rates that are going to be used. It also defined the actuarial tables. Now, the reason that those top 3 matter is because it did create what we call the grandfather category and then all others, non-grandfather, and I'll talk about what that means in a second. A couple other things that the Pension Protection Act clarified is it did clarify that non-spousal beneficiaries can do rollover. So prior to 06, if you weren't married, you had kids, or were using a trust, the rollover wasn't allowed to go to them directly, it had to be cashed in. It also clarified that after-tax balances can be rolled to a Roth IRA. That's a planning strategy. It also introduces what we call the mega backdoor Roth strategy. I've got webinars dedicated just to that topic. It also clarified that company matches can be diversified. So prior to 2006, many of you might remember, in order to get the extra 1% on the match, you had to have it all going into ExxonMobil stock. And after 2006, they allowed you to still get the extra 1% on the match, but it would be diversified. And then lastly, what the Pension Protection Act did was it defined IRA and 401k contribution limits going forward. All right. So with the grandfather category for the Pension Protection Act. So this was anybody who was over the age of 50 at the end of 2007, had more than 10 years of service before January 1st, 2008. There was effectively no change for your age group. Kind of to make it a little bit easier to describe this age group, you were over 55 and had more than 15 years of service by December 31 of 2012, or born before 1958 and hired before 1998. So the math for this age group is actually pretty simple. We take 95% of the 30-year Treasury rates. We round up or down to the nearest quarter percent. The other thing with this age group is we use the ExxonMobil year 2000 mortality tables. So again, year 2000, so it hasn't been updated in 20 years. Now, what we know about the 30-year Treasury rate is it's been on a pretty significant downward movement for specifically the last several years, if you look at just this segment here. But the point is that the Treasury rates have come down pretty significantly. And so what we're doing here is helping with modeling what rates have done. Now, we do know that the fourth quarter of 2020, as well as the first quarter of 2021, the discount rate, so again, we take the weighted average for the quarter times 95%, and then we round it up or down to the nearest quarter point. So for fourth quarter of 2020 and then first quarter of 2021, it's at 1.25% for the grandfather category. We're now modeling what the second quarter rates are going to be, and it does look like they're going to move up by a quarter point up to 1.5%. And so what we're also looking at is the sensitivity and what would need to happen for it to stay at 1.25 or go up to 1.75, so a 50 basis point move. And we know that there's 24 trading days left in the quarter. To go up to 1.75, we need the 30-year Treasury rate to get up above 1.89% and stay there for the rest of the quarter, and which we do believe is pretty unlikely, given that the 30-year right now is, as of today, about 1.65%. And then to go down to 1.25, we would need it to go below 1.22 and stay there for the rest of the quarter. So also unlikely. We think it's a pretty high degree of probability that we're going to see 1.5% for the second quarter of 2021. All right, so that's the grandfather category. Now, the non-grandfather category, this was anybody who was under 50 as of December 31, 2007, or you were born after 1957 or hired after 1997. This is where the Pension Protection Act kicked in. And now this is all based, for anyone who's in this age group, their discount rates are based off of 3 segments that are all focusing on high quality corporate bonds. Now, the segments are replicating durations of time. So segment 1 is applied to the first 5 years, and that's short-term bonds. Segment 2 is the next 15 years, and that's replicating intermediate term bonds. Segment 3 is replicating long-term bonds and applies to everything else up to age of mortality. Now, because they're corporate bonds, the rates are higher than the treasuries, and obviously higher yields mean smaller lump sum. The other thing with this age group was they applied the IRS mortality table, which is released by the IRS every single year. And obviously, because people are living longer, it actually is meaning that the mortality tables are improving for this age group. Now, these 3 segments, we're modeling these out and we're showing a little bit of the history here, but they've also been on a downward trend overall. And what we do is we create some blended segments to show you the impact of what discount rates are doing. But especially in the last year, all 3 segments have come down. What we've seen is segment 1 is kind of staying more flat. Segment 2 and segment 3 are starting to trend back up a little bit. And in large part, what got us here was the pandemic and a massive flight to quality, but then also specifically with the short-term rates, segment 1, the Fed. The Fed has been very active in buying high-quality corporate bonds, and they are continuing to do so. They've committed to continuing to do so for the foreseeable future. So we don't anticipate seeing a tremendous amount of movement in segment 1, but segment 2 and segment 3, the Fed's less involved, which is where we're starting to see the movement. Now, what we're doing here is showing those 3 segments. So segment 1, segment 2, and segment 3. And I'm going back a little bit of time to just kind of show you how these rates have moved. And as we've mentioned, the trend has been significantly down. Now, what we know is the first quarter of 2021 rates, And we know that segment 1 was at 0.52. We know that segment 2 was at 2.27. And we know that segment 3 was at 3.09. Now, what we do is we create a single rate equivalent in order to demonstrate and show what the impact of these rates are. So for example, somebody who's going to retire right on their 60th birthday, the single rate equivalent for them would be 2.35%. And someone that would be retiring right at the age of 55, the single rate equivalent for them is 2.49%. Now, the first quarter is a new historic low. It's the lowest it's ever been. And we are seeing a little bit of an upward pressure trajectory going into the second quarter. Right now, we are modeling that the second quarter rates are going to go up by 0.06%. Couple things with the all other age group. The discount rates are determined by what happens with the rates the last 2 months of the preceding quarter. So what that means in translating to English is October, November, December, that's the fourth quarter of 2020. But October had no impact on what the second quarter discount rates are going to be. Second quarter discount rates are only impacted by what happens in November and December. Now, October can give us an indication of trajectory, but November and December are what actually calculate the rates. We will get the official November numbers probably right around the second week of December, and then we will have the official December numbers in the second week of January. So come the second week of January of 2021, we will know the official discount rate for the second quarter. Right now, we're modeling and sending out projections. Couple things with this. With both the grandfathered category as well as the all other category, every week we send out our discount rate projections for the respective age groups. If you're not on that distribution list and you'd like to be, just send me a note or any one of my staff members a note, and we're delighted to add you to it. Again, it's just a weekly piece that we send out. But I do believe that we've seen somewhat of a troughing pattern for the all other category on the corporate bond side. And I do believe that we're going to start to see a little bit of a gradual rise back up in discount rates going into 2021. And then as soon as the Fed stops being an active participant in the corporate bond space, I do think that we're going to probably see a little bit more of a material increase in rates after that occurs. All right, so one thing that I wanted to demonstrate was a little bit of the sensitivity of what discount rate movements do to an actual lump sum calculation, and show you a more simplistic version of the tool that we use to model adjustments in what discount rates do and what those impacts would be to someone's lump sum benefits. And so this is just using a very basic example, somebody who's retiring in the first quarter of 2021, right at the age of 60. And as you can see, those same three segments I already mentioned. So segment 1 at 0.52, segment 2 at 2.27, segment 3 at 3.09. Now, this is assuming that the annuity payment for this individual would be $4,579.33 per month, or $54,952 per year. It's modeling a present value right at $1 million. Now, in order to demonstrate how the discount rates are actually impacting the lump sum, as I mentioned earlier, segment 1 applies to the first 5 years. So for this individual, it'd be their age 60 through 64. Segment 2 applies to the next 15 years, which would be 65 to 79. And then 80 through 83 is the exposure to segment 3. Now, going back real quick, just to show the difference between that single rate equivalent for somebody who's age 60 versus somebody who's age 55, well, it's that exposure to segment 3. So as I look at this modeling, what we can see is that if we were actually retiring at 55, we now would have 9 years of exposure to segment 3 as opposed to 4 years for somebody who's retiring at 60. And if somebody works all the way until the age of 64, they're not going to have any exposure to segment 3. It's relatively small in later years. But the point is that the longer you work, you're going to have less exposure to the long-term corporate bonds, which is the highest of the 3 segments. All right, now to translate this over in terms of what does a change in discount rate do to a lump sum valuation, we model different scenarios. Now, general rule of thumb is a 1% movement in interest rates is a 10% change to the lump sum. It's not quite linear, but you can kind of see the relative impact. So if rates go up, for example, by 10 basis points, 0.10, then it's about a 1% decrease in the lump sum value. So if the lump sum is going to be $1 million, it drops to $989,887. 25 basis point movement would actually be about a 2.5% decrease. So it drops down to just under 975,000. 1% movement drops by 9.5%, about 905,000. So it's a $95,000 differential for the 1% movement in discount rates. Now, if rates decrease, that causes the lump sum to go up. And that's what we've been experiencing almost all of 2020. But if rates go up by 10 basis points, the $1 million lump sum goes up to 1.01 as an example. Excuse me. And if rates go up by a full 1%, you're going to see approximately 11% change. So that increases the lump sum to 1.109 million. So just to understand some of the sensitivities. And as I mentioned, I do think within especially the segments, we're starting to see a little bit of an upward movement. The same relative adjustment does occur to the grandfather category. So as I mentioned, we are seeing rates increase by 25 basis points going into the second quarter, or at least that's what the modeling is projecting them to be, which is going to be about a 2.5% decrease in the lump sum values. All right. One question I get a lot is when should I consider delaying execution of the pension lump sum or just even the annuity? The first response always is if you don't need the money right away, you've got other sources to be able to live off of. The second is if you're retiring before the age of 60. And the reason is because ExxonMobil imposes what they call an early commencement discount. Now, on the annuity, it's approximately 5% per year. And so the longer you wait to execute, you're actually receiving some of that back. Now, the other reason we're going to recommend leaving this, and this is irregardless of age, but if you're going to take the lump sum and we expect interest rates to go down, obviously we want to defer it as well. We had a lot of folks that were part of the MLRP group that were unfortunately had to go on November the 1st, but because of the projections of discount rates going down, almost all of them we recommended pushing until the first quarter. And now obviously it's a new low. And as we're seeing rates rise, we need to have a conversation around the economics of if we want to leave it there or if we want to go ahead and commence those benefits. But it's an economic discussion. Now, one thing to comment, especially if you're under the age of 60 and you're in part of this non-grandfathered category, your benefit commencement date needs to be within that quarter. And so what that means is if you want to get the first quarter rates, your last possible benefit commencement date would be March the 1st. Now, the earliest could be January the 1st, but the last possible one would be March the 1st. Now, the reason, especially if you're under 60, we want to reduce any level of discount that's being imposed. But also the reason that we wait till March the 1st is because in order to have the package processed on time, we need to have your intent to retire package back to benefits 35 days prior to your benefit commencement date, so approximately January the 25th. The reason we do that is because by January the 25th, we are going to know the official second quarter rates, which are going to come out approximately the second week of January. So it gives us a complete arbitrage on this. And if you are in the position to have other assets to live on, you're under 60 and rates are staying flat or going down, then we need to have the understanding of what the impact would be of leaving that pension program at benefits without commencing and what that looks like. Excuse me. So what we did here was we modeled a retirement roadmap, and this is for somebody who's got a February 1st of 2021 benefit commencement date. And what we're doing here is showing what are those executable dates and things that we need to be looking at and considering, and what does it look like as time continues to go on. Now, this is more for illustrative purposes. I'm not making a recommendation here. And the reason is because right off the bat, if someone was part of the voluntary retirement program, the dates are going to be a little bit different. Now, typically what we would say for somebody who wants to execute February the 1st, their last day on the payroll would be January 30th. First day of retirement would be January 31st. The earliest that person would be eligible to request an intent to retire package is 120 days prior. So typically we recommend doing it 90 days. Now, obviously, anybody who's part of the voluntary program, the sequencing is a little bit different. I'll talk about that in a quick second. But it is taking benefits approximately 3 to 5 weeks. That's what they're telling everybody to get these packages back in. And as I mentioned, we need to have the package back 35 days prior to the benefit commencement date. Now, we are a big believer when that package comes in, you got to have your advisor review it with you. This is one of those things that we're making some irreversible life decisions here. And My team and I, we've done hundreds of them. Hopefully your advisor, if you're not working with us, also has that level of expertise. But to understand the documents that need to be executed and commenced. So when we go through that package, we want to review, we're going to talk about the lump sum versus annuity election. We're going to talk about if you're going lump sum, you need to have the pension election form. We'll check the box for 100% lump sum. We're going to need to do the qualified lump sum election form, have that filled out. You're going to need to annotate the custodian or firm that's going to hold the assets. Then at that point, we're also going to need to do the statement of legal residence form and verify your address. If you have a supplemental pension or a non-qualified pension or an additional payments plan, you need to have the non-qualified pension election form completed as well. And then I also recommend the direct deposit form for that. All right. I had a question come in. Why last day of work, January 30th, not 31st? Yeah. So this, again, I mentioned that when I started this wasn't necessarily a recommendation for somebody who's taking the voluntary program. If you are taking the voluntary program and have been selected now, the date sequence a little bit differently. For all of our clients, we build a custom one of these for. But if you are taking the voluntary program, the last day on the payroll is January the 31st. Your first day of retirement is February 1st. And then typically, dependent upon your age, your benefit commencement date would change. If you're over 60, I'm a believer, go ahead and have your benefit commencement date be February the 1st. If you're under 60, I absolutely want to have your benefit commencement date be March the 1st. Okay. Now, once we've completed that package together, as I mentioned earlier, we need to have it back 35 days prior to your benefit commencement date, which would be approximately December 28th. If you have a February 1st benefit commencement date, if you're under 60 and we use March 1, then you need to have it back approximately January the 25th. Now, once all of those funds come in, if you've taken the lump sum, your lump sum check will need to get deposited with your custodian. If you have a supplemental pension or an additional payments plan, we're going to have those set up to directly deposit into your checking account. And then at that point is when you need to obviously get them in the respective buckets where we're going to have them. And then we're going to revisit on investment strategy, cash flow strategies, and then we're going to talk about the savings plan. Now, I only mentioned the savings plan in terms of sequencing and timing. There is no obligation to roll over the savings plan as soon as you've retired. You can leave it at Voya. And candidly, that is my default recommendation until you are sure on what your strategy for execution will be. But once you are ready, that's where we want to go through. And in order to roll the 401k out of Voya, it is a phone call to Voya. The only thing you need to prepare for that ahead of that call, obviously we'll need to talk about strategy, but you'll need your 6-digit PIN specific to Voya. Very easy to get those. And then at that point in time, we need to do the call with them. I also recommend you got to have your advisor on the line for this call. I will tell you from my experience, approximately 60 to 70% of these calls have mistakes with them. And related to that, as soon as we're finished with the call, within a week, you're going to get a summary of the rollover. You also will want to have your advisor review that to make sure that everything was executed based upon what you told them to do with the call. But typically those calls take on the short end 30 minutes. I've had them go as long as 3.5 hours if there's mistakes. It's important to make sure, again, my team and I, we've done hundreds of these. You want to make sure you have somebody who knows these because there are specific tax implications related to that rollover call as well. And I do think it takes approximately 4 to 6 weeks to get all of that money moved, especially if you've got stock that we're moving in kind. All right. Somebody asked the question, how is the lump sum interest rate calculated? Is it a weighted average across the 3 segments? So I'm going to assume you're asking obviously about the non-grandfathered category. So the lump sum rate is calculated, and that's why I use this example here. So you can see the segment 1 applies to the first 5 years of someone's age post-retirement. Segment 2 is the next 15 years. And segment 3 is anything that's left. So when we look at these 3 respective segments, we know that segment 1 is getting the first 5 years, segment 2 is getting the next 15, and then segment 3 is getting anything else. And that's why when I had mentioned this example was for somebody who's retiring at 60, they only have 4 years of exposure to segment 3. Someone who'd be retiring at age 55, they're going to have 9 years of exposure. And then obviously if you're any iteration of age in between, you'll have less exposure to segment 3. Great question, though. All right. So that's the sequencing with regards to the timeline and the roadmap. And if you'd like me to build out a custom roadmap for you, just send me a note. We'll build one out for you. Happy to do it. And just kind of help with illustrating some of those critical dates and time, et cetera. All right. So in the near term, a couple things we always mention, but have a plan. Anybody who's currently in this environment, they really need to put themselves in a position to be able to make decisions quickly. Unfortunately, yesterday started the involuntary wave, and we are getting some of those folks reaching out. Have a plan. Put yourself in that position to be able to react to the environment that we're in. And with it, understand what your cash flow needs are and anticipated future expenses, and understand your long-term risk profile. As the markets continue to be volatile, which yes, November was a good month. I do think that we're going to get a little bit more of a run to finish the year out. I think 2021 will be a good year for the equity markets. But the point is if your goals and time horizons have not changed, your investment portfolio shouldn't change in terms of the asset allocation that it's in. I'm not saying don't change the investments in it, but your overall risk profile shouldn't change just because of market volatility. And obviously, we don't want to be making any type of investment decisions out of fear or greed for the long-term portion of our investment profile. All right. So again, just a reminder, if you haven't taken us up on the opportunity to do a financial planning strategy, absolutely no cost, absolutely no obligation. Great way to understand where your situation's at. Here's the contact information for my team and I. Mindy and Sydney are going to reach out after the event to thank you for attending and see if you had any questions. And then after I conclude, there's also going to be a brief survey. If you please take a couple minutes to fill that out. Really do appreciate it. Most importantly, stay healthy, stay well, and thank you for taking some time to listen. Appreciate it.